The Federal Reserve meets on July 28th and 29th, next week. This is one of the most anticipated Fed meetings of 2026 because the question everyone has been asking all year, when do rate cuts finally happen, may get its clearest answer yet. Today I want to give you the full picture of what is happening and what the decision means for your money. The case for cutting rates. The US jobs market is weakening. June came in at 57,000 jobs, less than half of the 117,000 expected. Multiple previous months were revised downward. A weakening labor market is the classic signal that monetary policy is too tight and economic stimulus is needed. When people lose jobs, they stop spending. When they stop spending, businesses lose revenue. The cycle accelerates in the wrong direction without intervention. The case for holding rates. Inflation is at 3.8%, nearly double the Fed's 2% target. Oil just spiked to $87 per barrel on renewed Iran conflict. The Panama Canal is adding shipping cost pressures simultaneously, cutting rates into a re-accelerating inflation environment. Risks reigniting the exact inflation crisis that caused so much financial pain since 2021. New Fed Chair Kevin Warsh has been explicit. Price stability comes before economic stimulus. What the Fed meeting minutes already revealed. The minutes from the June meeting showed significant internal disagreement. What was described as a family fight over rates. Some members want to cut now given labor market weakness. Others want to hold given inflation persistence. This disagreement means the decision next week is genuinely uncertain, which is why markets are moving so much in anticipation. The most likely outcome and its market impact. Most analysts expect the Fed to hold rates unchanged next week given the oil spike and inflation concerns. But the language of the statement, specifically, whether they signal cuts are coming soon, will be as important as the decision itself. A statement that signals September cuts as likely would immediately push mortgage rates down and growth stocks up. A statement that pushes cuts further into 2027 would do the opposite. What this means for your financial decisions right now. High-yield savings accounts are paying 4 to 5%. That window is open because rates are elevated. The moment the Fed cuts, these rates fall quickly. If you have short-term savings not yet earning these rates, move them before the decision next week. Whether the Fed cuts or holds, the direction of travel is eventually downward. The high-yield savings window will not be open forever.